Welcome to my channel. I'm Scott, and in this video we're going to talk about how do you define a bear market, how do you invest in one, and how do you approach it. On the first slide we're going to define a bear market, talk about the causes. I'll show you a graph of all the bear markets since 1950s, how long they lasted and how long it took to recover. The phases of a bear market, how to react and raise capital, what to invest in, and a summary. So what is a bear market? There's lots of definitions out there. I think the one that makes the most sense is when a market declines by 20% or more. So in a traditional sense, that's when the S&P 500 or something like the Russell 2000 declines by 20%. But it's also possible to talk about bear markets in a certain sector. There could be a bear market in tech while durable goods is going up. But you should really understand bear markets can last only a few weeks, they can last a few months, or sometimes many years. Like for instance in 2020, there was a bear market for 1 month. From February to March 2020, the market went down 33% and it took 5 months to recover. Where in 2008, the market went down about 58% and that was over 1.5 years. And it took 5 years for the market to recoup those losses. You'll notice stocks go down a lot faster than they go up, but stocks go up over time. Another way to think about a bear market is when more people are risk averse than risk seeking. There's always going to be people out there that are risk averse no matter what the situation. But if there's more people out there that are not buying stocks or buying homes, then there's a problem. Because when people stop buying assets, there's less demand, less jobs, and that's why the market declines. So in order for the market to flourish and prosper, people need to spend money. So let's try to identify what causes a bear market. As you can imagine, there's lots of things that cause a bear market: a weak or slowing economy, and when there's a big bubble that pops, that leads to a weak economy. Like the housing crisis in 2009, that led to a pretty bad recession, the dot-com crash in '99, and more recently the COVID pandemic shot the world economy. And also wars can trigger a recession or a bear market. Like when those 2 planes hit the World Trade Center back in 2001, this led to us invading countries in the Middle East. And there's also drastic paradigm shifts in the economy. Like when the internet started to really take off, lots of businesses went under. For instance, nobody really needs a camera anymore, they can use their smartphone. So if you sold cameras, you would have to pivot to something else. Newspapers are still around, but the demand has definitely declined. And the main signs to look out for in a bear market is high unemployment, because when people don't have work, they really can't spend much money. Low disposable income, so if your salary went up 5% from last year, but inflation is up 8%, you have less money left over to spend. When companies have weak productivity and they're making less money or even losing money, that could lead to lots of problems. And it seems like any intervention by the government can lead to a bear market. Quantitative easing, when the government buys bonds, they're trying to put money into the market. Quantitative tightening is the opposite of QE. That's when the government sells bonds, which improves their balance sheet, but it takes money out of the economy. And more recently, the government offered student loan forgiveness, which is going to result in higher taxes for the everyday person. And also, of course, when the government raises or lowers interest rates. So here's a chart of all the bear markets since the 50s. The blue line is the length of the bear market, the orange line is the recovery. Usually the recovery is a lot longer. Like in 1973, there was a bear market for 21 months, almost 2 years. But the recovery was almost 6 years. So the market went down 48% in 21 months, and it took nearly 6 years to get that back. The fastest bear market was in March 2020. In 1 month, the market went down 34%, and it took 5 months to recover. But the hard part to know is how long the bear market will last. Will it just be a few months? Or will it be a couple years? And even if you could time the bottom, you don't know how long it's going to take to recover. It's a lot easier to make fast cash if it takes 5 months. You can buy options and make a lot of money. But if it takes 4 years, that could be a really painful time to wait. So let's talk about the phases of the bear market. The first phase is high stock prices and strong investor sentiment. An example of this is from April 2020 to December 2021. You can see how stock prices went up a lot until the end of 2021. Towards the end of the first phase, investors drop out and take in their profits. In the second phase, like the first 6 months of 2022, you see a sharp drop in prices. So trading activity and corporate profits really start to suffer. Then capitulation occurs. This is when fear takes over and people start selling and the prices drop even more dramatically. Investors think the world is coming to an end, so they gotta get all their money out of the market and hold cash. In the third phase, which we see right here in June 2022, some people do enter the market because prices are getting really low and you see an increase in trading volume. We might be on the last phase right now. This is when stock prices continue to drop slowly. But some people say the market's going to drop another 50%, so this might not be the bottom. No one really knows the bottom. But at the end of the fourth phase, low prices bring investors back and the market starts to recover, and then we enter a bull market. So how do you react and raise capital in a bear market? Well, you always want to stay calm and not panic, because if you panic and stressed, you're going to make poor decisions and lose more money than you would have. The problem in a bear market is you have all your money invested in the market, so you don't want to sell at a loss. You have to find ways to bring in new capital. You could work more hours or ask for a raise. That's probably the easiest if you have a current full-time job. But you always want to save a fixed amount of money each month. Doesn't matter what it is. It could be $50 a month, $500 a month, $5,000 a month, whatever your situation is. Try to have a goal, because if you don't have a goal, you'll end up saving nothing. Finding a second job or side job is a great way to bring in money. And even if you're working a minimum wage job, don't be ashamed. A few $100s extra a month goes a long way. Whether you're a big multi-billion-dollar corporation or a college student making $10,000 a year, there are really two ways to generate more cash flow. Raise your income or cut your expenses, or both. Those are the two main ways. You could also take on debt, and we'll talk about that later, but the two main ways are to increase your income or decrease your expenses. So if you pay someone to mow your lawn, you can do it yourself. Instead of going out to eat, you could go to Costco. There's many ways to cut expenses. Selling assets, have a garage sale. You could downsize, sell your car, lease a cheaper car, sell your home and rent. It's a good time to sell your home because the housing market is still high. If someone owes you money, try to get that money from them. You could refinance your home, assuming you get a better interest rate. The things in red I wouldn't suggest, but they are ways to generate cash flow. Taking a second mortgage, a HELOC. You could draw against your retirement or life insurance, but you don't want to pay too much in penalties and fees. And you could take on credit card debt, but I probably avoid this unless you get a really low introductory rate, but you want to pay it back before the high interest kicks in. And like Warren Buffett says, when others are greedy, be cautious because you might be overpaying for something. And when others are fearful, you probably get something at a really big discount, like buying Christmas presents after Christmas ends. Now the hard part to figure out is, what do you invest in? Well, you can stick to safer investments like bonds or commodities like gold and silver. I think it's fairly safe to invest in stocks with over 100 billion market cap that pay a high dividend. You could also invest in preferred shares. This is a hybrid between stocks and bonds. Because preferred stock, you get a guaranteed dividend payment, and you also get some price appreciation similar to a common stock. And during a recession, people are more likely to shop at discount stores like Costco, Walmart, Target. But you don't want to just invest in a discount store just because they sell cheaper products. You also want to understand the company and look at their financial health. Personally, I don't change my investing strategy. I pretty much keep it the way it is all the time. I put money into different ETFs like SPDR. I prefer to invest in large companies above 100 billion market cap with strong cash flows. Also, I like to invest in companies that sell products or services that are easily scalable and are in high demand. I used to have a good amount of money in VT, Vanguard Total Index Fund, so if you want to spread it around in some foreign stocks, that's okay as well. Commodities tend to be a safe hedge like gold and silver. I have some money invested in ET, Energy Transfer. This is a midstream oil company. Real estate is a good investment. I did have some rental properties. I sold them and I used that money to buy my home. I did have a business for 10 years. I sold it last year, right before the market crashed. Just good timing. But you really want to avoid trying to time the market. You will get lucky once in a while, but you cannot do it consistently. And when I invest, I think, will this company be around in 10, 20, 30 years? So a company like Costco or Google, I feel pretty confident they'll be around in that time. Of course, anything can happen, but you want to stick with companies that are stable and have good long-term prospects. Unless you do lots of due diligence, you probably want to avoid penny stocks. You could put maybe 5% of your portfolio in them, but I wouldn't go too high. I'd probably avoid small cap stocks that pay a dividend above 10%, and I'd also avoid stocks that have gone down 50%. But a company like Amazon went down 90% in the .com crash, and look at them now. So to summarize, you have to remember stocks go down a lot faster than they go up. But over time, stocks always go up. Individual stocks, maybe not always, but the entire market always. In any 20-year period, the stock market has gone up. And you always want to stay calm and avoid making rash decisions. And this statement is not just for the stock market, but pretty much anything in life. So here's a calm example. I lost about 50% of my investment, $50,000 on this penny stock. It was called Waiter Holdings. And I thought the company had something special, but then I started to lose faith. So I sold the stock. And I lost $50,000 on my Facebook stock this year, but I do believe in a company long term and I held it. Just because a stock goes down a lot doesn't mean you have to hold it and wait for it to go back up again. You're probably better off selling it and putting your money in a stock that's going to go up faster. So you have to ignore the past. Look at it as of today. Would you buy the stock today? If the answer is no, then you should probably sell it. And always just stick to the fundamentals, the basics. Limit your risky investments. Put your money into strong companies with a proven track record. And if you just hold long term, try to ignore the volatility and try to limit how many times you look at your portfolio. You're probably going to be a lot better off. Thanks for watching the video. Leave a comment. Let me know what you think. Subscribe. Talk to you soon.